Let's start with Julius, because he did not just teach me what a stock was, he showed me what an investor looked like when nothing exciting was happening. I vividly recall every 3 months when his investment statement would arrive in the mail. He would look at it for a few seconds. If the account was up, he would smile and joke, "Okay, great, we can eat dinner tonight." If it was down, he would put the statement away and barely react. As a kid, I thought that was a little strange, but looking back, that was the lesson. Investing was not supposed to run his emotions. It was not supposed to demand his attention every day. He owned businesses. He was patient, and he gave them time. This was not indifference. This was perspective. And this is important for us as parents. Our kids are not only listening to what we tell them about money, they are watching what money makes us do. If we panic every time the market falls, chase whatever just went up, or check an investment app through dinner, those are money lessons too. Julius taught me composure without ever calling it composure. Now here is where I have to be honest with you. Learning that lesson early did not mean I always followed it. When I was in high school, I asked Julius if I could invest some of my bar mitzvah money. One of my first investments was a biotech company called Neorex. My Neorex investment multiplied dramatically in value. I thought it was a genius. And I even convinced my mom to allow me to go to school late so I can sell it at the open after a major price spike. But could I explain the company's drug pipeline, the risks, the valuations, or what I thought it was worth? Not really. The price had gone up, and I allowed the result to convince me that my process must have been good. So I took those winnings and put them in AOL after they merged with Time Warner. And then I watched most of my AOL investment disappear. On the way up, I thought I was much smarter than I really was. On the way down, I thought I was much dumber than I really was. The truth was neither. I was a young investor confusing an outcome with a process. That distinction matters. A bad decision can produce a good outcome, and a thoughtful decision can produce a bad short-term outcome. The result does not prove whether the decision itself was sound. In my opinion, one of the most dangerous things that can happen to a young investor is making money for the wrong reason, because the market may reward a bad habit before eventually punishes it. That is why we should not teach our children to only ask, "Did I make money?" We should teach them to ask, "Why did I make the decision? What did I own? What can go wrong? And did I follow a sound process?" Now let me connect that AOL mistake to what is happening today. The premise behind AOL and Time Warner merging was not completely irrational. The thesis was simple. AOL had the internet pipes to people's living rooms. Time Warner had all the content. And the internet really did become a major way that movies, music, and entertainment reached our homes. That future arrived. But being right about the direction of the future did not make AOL the right company, the merger the right investment, or the price the right one to pay. Other businesses, like Netflix, still a young DVD by mail company at the time of the AOL-Time Warner merger, ultimately captured much of that value in the ways investors did not necessarily anticipate. Now think about AI. AI may change the world. I think it probably will. But a world-changing technology does not automatically make every company associated with it a good investment. A great theme, a great business, and a great stock at today's price are three different things. You can be right about AI and still be wrong about the company, the price, or how much money you put into it. This is the difference between approaching the market as an investor and approaching it as a gambler. And to be clear, trading itself is not automatically gambling. But a lot of what young people see today turns markets into entertainment. Short-term bets, oversized positions, the use of leverage, constant checking, and the belief that one hot streak proves you figured it out. An investor asks different questions. What do I own? How does it make money? What am I paying for it? How much of my portfolio should it represent? What is my time horizon? And what would prove my thesis wrong? A gambler mostly asks, how quickly can this thing go up? You do not need to teach a 6-year-old discounted cash flow analysis, but you can begin by teaching them that investing means ownership, that price and value are not the same thing, that excitement is not analysis, and that one lucky win does not make you a genius. Most importantly, you can model that behavior. Julius never gave me a formal lesson on investor psychology. He showed me what it looked like every time he calmly put that quarterly statement away. So those are your first two lessons. Ownership means understanding what you actually own. process means knowing what you own, how it fits, and what you will do when the market tests you.